Good afternoon. I'm Lena Dalbey. My firm is Link Capital, and you've come to the best part of the day, right? Because we're finally going to talk about funding, right? Smart Funding Summit. So my panelists today represent over $600 billion in capital and lots of different flavors of commercial banking, and all of them have so much perspective and wisdom and passion, Matthew, to share. So I will let them introduce themselves and a little bit about your organization, and then we'll jump into some questions. So Ryan, why don't we start with you?
Sure. I am Ryan Edwards. I manage the Southwest for Silicon Valley Bank. So my focus is working with technology and venture companies. So that's venture VC firms, as well as typically venture-backed companies and technology companies that are typically really fast growing and looking to scale, raise capital through both debt and equity means to get to typical multiple exits based on their revenue. So that's roughly the overall. I cover Arizona, Nevada, and New Mexico as my territory. Originally from the Bay Area and came out here about 5 years ago, and it's been really fun to get to see the Arizona ecosystem starting to grow and scale as I've been here. And I also want to say thank you for staying for a banking panel. So good.
We're going to make it fun. Matthew.
Yeah, so Matthew Mapes. So I run the SBA division for Sunflower Bank. So we're about a $4 billion privately owned bank headquartered in Denver. We operate in Arizona, Colorado, New Mexico, Texas, Kansas, and a little bit into Missouri. So if you manufacture a product or provide a service and you're looking for capital, that's kind of the world that I live in. So not as much on just the technology, high growth trajectory, but even just your everyday mechanic, someone looking to buy equipment, purchase a building, things of that nature as well.
And Terry.
My name is Terry Switz. I work for BMO Harris Bank here in the Valley, live in Phoenix, been a commercial banker, corporate banker, and capital markets banker for the last 20 years. Work with middle market companies here throughout the greater Southwest.
So we've been talking about growth all day, and I can't stress enough how important that your lending relationship and your capital partnerships are in growth companies. So you gave us a tiny inkling, but I'd like each of you to describe in a little bit more detail what is it that you're looking for in a relationship, and when should companies get to know you and understand if you're going to be a good mutual fit for one another. So Ryan, why don't I start with you?
Sure. So as I mentioned, kind of the focus is very targeted for me. So I am typically looking for companies that really want to go down, grow as fast as possible, which usually means venture-backed businesses or companies that are going to be going out to raise equity to scale so they can put that money knowing, hey, if I allocate this amount of capital, I can scale this quickly. So however much capital I can get is almost good because I know I can use that for faster trajectory of the business. So for me, it's making sure it's a fit when I'm working with someone that's their target, right? There's a lot of companies I run into that maybe their mindset is, oh, we want to be a venture business, or that's what they perceive as a venture business. But I think oftentimes don't know what that means. That to be a venture business means you're going to have someone that's really involved oftentimes in what you're doing, putting a lot of pressure on you. There's that level of work that sometimes is where people aren't comfortable doing, that they're going to be heavily engaged all the time with this business. It becomes your life. That's kind of my perception, having worked with entrepreneurial, fast growth businesses for the last 10 years with Silicon Valley Bank. And so I think understanding that's really what I want to get at age. If it's an entrepreneur and that's the business model you're going after, it makes sense for me to be talking with you early so that we can figure out when is the right time to help with introductions to investors and connectivity with, when is the right time for debt, all those types of things, having those discussions early on so that there's expectations set, because I don't want people to waste their time either going down the path of, I'm going to go do this and go raise money, but you're not ready for that, and the investors you're talking to aren't ready to talk to you. So that's kind of a little bit, I guess.
I'm just going to ask you one follow-on question. How accessible are you? If a company says, hey, I want to grow, I want to be spectacular, do they have coffee with you? Can they reach out to you? Do you have people that help you? What does that intake valve look like for you?
That's most of my day, yeah, is meeting with companies, and that's from pre-revenue, people who have ideas, all the way up to companies that are doing, multiple tens of millions of dollars of business. So I'm very available. You know, I'm involved in Venture Madness competition on the board there, which is a lot of those companies, including Digitile, was involved with that. And spending time with those companies and giving them feedback and trying to help them to understand what they're going to need over time is important, right? I think not everyone knows. You don't know what you need until you've been through it. So I love being involved in that process. I don't feel like I'm an entrepreneur because I'm in banking, but I love being around that entrepreneur ecosystem, and I think it's really fun that I get the background of seeing hundreds of companies going through that process. So even though I'm not actively doing that step-by-step thing, I get to see the good and the bad from a lot of what people have done.
So we're going to come back to that. But we talked earlier about targets. Matthew, I think your target is a little bit different. So why don't you tell us what you're looking for?
Yeah, so instead of a company that's really looking at revenue growth, I think in order to start a relationship with your typical bank, a lot of it comes down to cash flow, at least from a lending standpoint. You know, at a bare minimum, I would be looking at, 18 months of historic cash flow. And the definition of cash flow is different to different people, but from a banking perspective, we're really trying to say, like, take your net income, add back some intangible depreciation, interest, and compare that to the proposed debt service, whatever loan you're looking for. If we can hit a minimum ratio of probably like 1.25, meaning you have $1.25 for every dollar of debt service, that's kind of the initial threshold where typical banks would look at doing a loan. What I think a lot of people miss, though, is that banks want relationships with deposit customers as well. And it's not just when you need a loan that you should be looking at a relationship with a bank, because deposits matter just as much. You know, we make money on the spread between what we take in deposits and what we're lending out. And so having those deposits and having those relationships go a long way in when it comes time for a loan. If you have an established relationship and you actually have a banker that you know, I think that's something that can really add a lot of value when that time for capital comes.
All right. And Terry, how about you? Because I know your organization is also unique.
Yeah, I think I would echo Matt's comments in terms of I'm wearing my lending hat, making sure that, there may not need to be GAAP profitability, but there definitely needs to be cash flow and revenue to generate a lending relationship, and the earlier the better. But at BMO, we're a global financial institution, fully capable commercial bank and investment bank. So when we go to a client, it's really, what is that client trying to accomplish? Is it a strategic alternative? So are they looking to grow the business? Is it through M&A? Do we want to help them buy other companies? Do we want to help them dispose of certain business units or assets? And to do that, is it debt from the bank, or is it capital markets related debt or equity? So really kind of taking, and I wouldn't say you're not taking a consultative approach, but we just may have a few more arrows in our quiver and to figure out what that company really needs.
So one of the words you'll hear a lot in our industry is relationship, partnership. And I want to flip it around. For the growth companies in the audience that want to form a partnership or a relationship with a lending institution, what are your expectations of them, right? Because we know there's going to be bumps in the road, there's going to be disclosure. So Terry, I'll start with you. Turn the table. What is your expectation of your borrowers?
Sure. Going through this right now, to have full command of the business, full command and ownership of the numbers, understanding the contract that we're doing business under, so the credit agreement, and if there is a bump in the road, to come to us early rather than later, because most times we don't want to get in the way of the company trying to do business, but if we have that transparent relationship, I think we're more apt to want to be flexible and to work quick to solve that problem. It's those companies that have those issues come up, and we're asking them, like right now, the company's looking to acquire another business, and their first reporting period was 6/30, and they haven't gotten us their financials or their compliance certificate. We're pulling it out of them and finding that they're out of compliance, and they want to close by the end of October. And it's like, if you would have come to us early knowing that you had this issue, we could have resolved it months ago and probably not be in a situation where we're going to delay the acquisition of this business that you're trying to acquire.
And so when I hear a delay like that, tell us a little bit more, like why, right? Why is a company struggling to report in a timely fashion? What are you seeing?
Yeah, sometimes I see smaller companies, this is a $100 to $150 million business.
Small company, 150 million.
Sorry.
It's relative.
We're working with anywhere from 20 million in revenue to 3 billion in revenue. So there's a broad spectrum of size of companies, and sometimes the zeros get in the way. So it's a $150 million company. He's got a CFO who's extremely competent, but looking at 4 different acquisitions in his M&A pipeline, which is really taxing the rest of his staff, which is lightly staffed. So he's given us the reason that he and his staff have been on planes doing their diligence on these targets. That being said, that really doesn't work for us. Again, you should still have command of your business, command of your numbers, and be transparent and come to us early rather than later so that we can surface those issues and work through them together.
So I want to stay on expectations for a couple seconds because I think you guys have good stuff to chime in. So Matthew, talk about your expectations.
I want to set some groundwork here first. So my borrowers a lot of times aren't necessarily as sophisticated, or they're earlier in their life cycle as compared to what Terry's talking about. So my typical loan size is probably about $1 million, and my borrowers are anywhere from 800,000 in revenue to 50, 60 million in revenue typically. I think the word partner is one of those buzzwords that's used a lot, especially in our industry. But I think that people don't really understand why it's not a good term for banking. We are not a partner. We're really supposed to be a trusted advisor. Your banker should be adding value to you. But we're not taking equity in your company. You can grow your company and sell it for 150 million. We're still just making our principal plus interest. And if you look at banking, I mean, all banks have call reports, it's public information. But if you look at like a return on equity and a return on assets in our business model, a typical goal is about 1%. So that means we're going to make, after all of our expenses, about 1% true return on assets. And when you look at that and you try to calculate like the risk to reward, that's why I think banks come off as looking really, really conservative. But it's because we have to be. We can't just do a shotgun approach. We're not getting warrants in your company and getting this big equity payout. We have to be a very rifle-specific approach. Because if we even have a $250,000 loan go bad, at 1% return on assets, I need to book 25 million of new loans just to make up the money I lost. So I think it's important when you're looking at banks that you understand what you're getting, and you should have someone who's adding value and really working to give you some kind of advice. And as a bank, what we're looking for is people who want to take that advice. The customers who I've seen have been the most successful surround themselves with really smart people, and they are willing to take advice and get help. And that's what I think bankers really want. We want someone who's going to be transparent and honest with us, show us the good, the bad, the ugly, and let's work together to find a way to mitigate around that.
I mentioned we have 3 different flavors of commercial banking. Ryan, I want you to jump in. Tell me about equity compensation, your returns, and also you tend to have 2 constituencies in your borrowers because so many of them are VC backed. So talk to us a little bit about, you generally have a company, but you also have a very strong equity partner with most of your clients. But also talk to us about the way in which your bank is compensated, and do you have equity in some of your clients?
Yeah, so ours is very different
Like a
model,
180,
obviously, than kind of than the traditional bank model. So we do get equity in a lot of our clients, and we do have warrants in our clients, and so that dynamic does change things a lot because it does incentivize a little bit differently. Like the bank is somewhat incentivized to try and make sure companies are the most successful they can be, because we're honestly aligned with that exit being valuable. So and that's one thing that's interesting, because that's something that sometimes we get pushback. Obviously, nobody wants to give up equity and things like that. And depending on what we're doing, if we're doing something that's outside the normal of a traditional bank, which we often do, I'd say 90% of my borrowers are losing money, which most banks would never, ever look at. Also, most of my clients, we don't really have personal guarantees almost ever, which again is something that's not really normal in the banking industry for most companies. As you start to scale, obviously that goes away, but for companies smaller, maybe below 120 million, it's there's still sometimes more of that, and so for us, our return is still, I'd say, very standard to what bank pricing is. We're not charging high crazy rates or something in the teens or sub debt type pricing, but we have that upside of look, we're taking risk at an earlier stage than a traditional bank often does. So there is some association with getting paid a little bit outside of if there is a liquidity event in the future, we would want to participate in that outcome as well.
So we're learning a little bit about that price of flexibility, right? If we want more flexibility, a company's going to pay a little bit more for it. We've heard a lot of successful companies today and successful stories, and I'd love to get a banker's perspective on what defines success. And so I'll open it up. Can each of you share, a company, a story, a relationship that was successful inside your institution, and tell us a little bit more, like who were the founders like and why was it a success in your view? And I'll let anybody jump in that would like to start off with that one.
Yeah, I'll jump in. So I'm working with a company right now called Proctorio. It's a technology company here local who has created a technology to really use like webcams to help proctor exams. And they're scaling and growing rapidly. So it's a high growth company. And the business owner that I'm working with, I think he's been really, really successful because he realized first off that he had something really special and that in order to protect it, he needed to get someone to kind of give him some coaching. There becomes a little bit of group think when you just surround yourself with like-minded individuals. And I think that getting someone from the outside to come in to look at the big picture and help him work on the business and not just in the business was critical. And in doing so, that advisor helped him, bring in someone to do, compensation analysis and branding and kind of making sure that they do all the right things from a financial perspective to where when a bank looks at them or an investor looks at them, that they're going to look really good. As the company's growing in the early years and there's this rapid growth, they're kind of like a teenager. You can eat a lot of junk and get away with a bunch of stuff and it's all okay. But when you get to that point where you think you might have an exit 2-3 years into the future, you really need to start kind of tightening up the fiscal belt and clean things up. And I think the success for a lot of these business owners who do have a really good exit is taking the steps years in advance and not just waking up one day when they have an offer from a PE fund. So,
Terry, you've seen a lot. Give us a story.
Sure. There was a business in Colorado when I was out there in oilfield services. It was a small $20 million company, and the founder and the silent partner realized that there are one service business serving commodity-driven cyclical industry. And for them to survive and make money and be competitive, they needed to acquire other services and other businesses. I thought what was great about them at that time is they realized they were going to stress the system and stress their infrastructure. So they took a pause and invested heavily in their systems, in their people, and overstaffed and had accounting systems and ERP systems that companies at $20 million typically would not have, knowing that the add-on of these other businesses was going to require that infrastructure. And we ended up taking them from 20 million to 250 million in about 3 years. And it was a fun ride to be with them, to see that vision come to fruition with them. And it was great being able to have connectivity at all levels of their staff as they were kind of deploying this vision. And were able to not only do it out of Colorado, but make sure that their presence was in about every basin that was active at that time. The flip side of that, and why I think ultimately they were successful, is that infrastructure allowed them to dispose of assets and control their costs when the cycle turned. And they're still in business today. So, not
Ryan.
250 million anymore, but they will be.
And Ryan, your firm is associated with so many success stories. Give us something you've worked on and why you enjoyed it.
I'll give my favorite one that I have worked on with my time in the bank, which is a company out of the Bay Area. And this company I was working on when they were probably, I think I first started working with them, they were probably 10-ish million in revenue, something like that. And at the time, their main competitors were Apple and Google, and pretty much that's it. And I remember starting working with them and feeling like they don't have a chance at winning this market. This is their biggest competitors were behemoths. They had way more money to spend than they did in the marketplace. Their product their product was good. I never had an issue. I felt like they had a good product, but I just felt like they could never outspend. And if either of these competitors decided to take the market as much as they wanted to, it was going to be gone. And I watched this company grow and scale. They actually got an opportunity to get acquired from a large company out of Seattle. And I was involved as that process happened. And this is where it's so interesting, because I feel like as a banker, I'm so conservative minded, which is why I cannot totally get inside the mind of the entrepreneur. But they pushed back really hard on an acquisition that was going to happen this time, which would have been really a huge outcome for their investors. They'd only raised, I think, 20 million or so at the time. Their investors would have done well. Management team would have done. I mean, it would have been an amazing outcome. And the CEO, so passionate, it felt like they could take on this market, and ended up saying, like, nope. They ended up getting an offer at that point for about 120 million of extra capital to come in at a pretty high valuation. He then went back to this large company and said, we're worth this much now, so give us that or that's it. They said no. He walked away, and the CFO left. Some other people at the company left because they felt like, this is crazy that you're walking away from this type of thing. And I was so amazed, both with the passion and also potentially concerned with the stupidity that was happening. and I was going, wow, this was wild. We also had warrants at the time. We would have done well, but we also were like, you know, the CEO at the time owned about half the company. The investors really said, it's up to you. And he passed, and we looked at it and said, this company's going to have to be worth at least $1 billion in a public company now for them to make the amount of money that they were going to make. And they're raising more, so that was getting harder and harder. So that company, if you guys don't guess, is Roku. And so it was amazing to watch that scale up after they said no to that offer, and getting to then see them scale for years and years over that time. And I was like, wow, you know, you go after it, you know your market, you feel passionate as an entrepreneur, it's amazing things can happen.
So the IPO was a good day for you.
They have warrants.
So we've touched upon myths a couple of times today, and I love the theme. So tell us about a banking myth. Is there a myth out there that you run into, and what do you want this audience to know that could be something that's not quite true about commercial bankers? And give us a myth. Terry.
Yeah, I'm going to speak against what you had said about being partners. We struggle with this internally all the time. And everyone wants to become the advisor to their client. And I think the way that we try to do it is to overcome the myth that we're just lenders coming to the table to just provide capital, is to try and harness the entire bank and listen to the company and let them know that we're here to help them grow. And that's either by providing capital to them or accessing other forms of capital, or thinking strategically about, you know, we have 30,000 clients throughout all of North America. We know who those clients are, and why shouldn't we be introducing you to those clients? So I think it's overcoming the myth that the banker is the lender and just looking at them for capital.
Interesting. Okay, Matthew, how about you?
No, that's good. You know, from an SBA perspective, a lot of people think that SBA loans are government loans, and you're getting a government loan, and it's really not. I mean, you're getting a loan from a bank. The government's not in the business of lending money, so it is a government loan that has an enhancement with an SBA enhancement. And the best way to understand that is kind of FHA is to residential what SBA is to commercial. It allows the bank to reduce their risk profile so they can offer better terms to you. You might have less equity, longer amortization, no balloons, things of that nature. And in return, the bank is getting a loss sharing program. So out of every loan that's done, there's a fee charged to you as the business owner. The bank typically finances that, sends it to the SBA. And then every month when you make a payment, the bank's taking a portion of that interest and sending it to the SBA as well. So in a liquidation event, when something doesn't go right, after the bank liquidates collateral, we get to go back and recover a portion of our losses. So it's really a loss sharing program where it's not subsidized by the taxpayers, and that's why it's been around for so long. And when I'm meeting with business owners, one of the myths is they kind of think, you know, SBA is beneath them. as compared to conventional. And we will always offer conventional and SBA together whenever possible and let the business owner choose. And it's really just a tool. It's not good, it's not bad, it's a tool for you to use. And a lot of times when companies have a CFO or a controller, when they look at their return on equity and preserving capital and getting longer amortizations to get more cash flow out of their debt, a lot of times they'll choose SBA because they can look at the cost of those fees associated with the lower debt service and less down payment.
Ryan, how about you?
I think I would say there's and this, I don't know how much this is totally a myth, but banking in a lot of ways is a commodity, and so I do think that is partially true, but I think the myth part around that is you kind of get what you put into it too as a company. I think a lot of the companies that I work with want to connect and find out, we work with tons of venture firms. We work with about 70% of the venture capital in the country. We work with half the venture-backed businesses, and it's like, if companies reach out and they want data, they want introductions, they want connections to people, it's hard when you're doing that to try and make sure you're in front of all your clients all the time and trying to put what you think they might need. Whereas if you get the reach out of, hey, I'm trying to understand this, can you help me with this? I think there's a huge willingness to do that. I know on my side and in the people I work with, there's definitely a desire to do that sort of stuff. And so the myth that, well, it's just a commodity or a checking account, it's kind of like you get what you put into it in a lot of times, just like with anything else. And I think the opportunity to utilize more of those types of things to create that partnership is also there if there's desire.
I think I have like one point on that, and I don't know if you come into this, but like a good story or a good example is there's a company here in the Valley right now, grown from startup to a publicly traded entity, recently starting to go overseas. The treasury team isn't exactly proficient in foreign exchange and hedging those currency risks. So they've come to us for the first time and asked, can we help them build out the platform and share resources with them on how they would put in the proper controls, and then how should they start to value and look at those risks and what kind of trades should they put into place. I don't know, like to your point, like I don't have a lot of clients like calling up asking like, this is the first time. I think some of them are just like, we should know how to do this. Why would we call? Or maybe they'll look outside to a consultant and pay money when we're making money off this relationship and we have those resources, and we can be your first line of questioning to give you some of those answers for free, right? So.
And to use this as a Rolodex. I mean, bankers have a lot of contacts. I mean, we get to pick the brains of business owners all the time. So if you're looking for certain contacts and you don't happen to have them, call your banker. I mean, they might have someone that they can connect you to, and odds are if they do, they're going to go out of their way to try to make that happen.
It's a perfect segue. I'm going to ask these guys one more question, then open it up to the group. And obviously, what we're hearing you say, it's more than money, right? You bring so many more resources. But if I could also ask you to give like one or two more thoughts to this audience that sees innovation, sees growth, wants to be successful, wants to be the success story that these guys are describing, right, a couple of years from now. What's one more thing you'd like this audience to know? And then we'll jump out and answer some questions. What should they know about you and your institution that they might not? Or a piece of advice?
The only piece of advice I would give would be to be humble. We run across a lot of very successful business owners, and a lot of the ones who are the most successful are really humble, and they're connecting themselves with other people who can make them better. We'd like to think that it's the banker, the attorney, and the CPA who are really just the trusted advisors. But a lot of times it's the other business owners that, people who've been through similar situations who can add value and speak from a position of experience. So surround yourself with really good people and I guess take advice.
I would say, just kind of piggybacking a little bit off the last panel around some of the stuff that was discussed around secrecy and IP and things like that. I think what I've found for a lot of the companies I've worked with over the years is that the companies that are kind of the most open seem to be the most successful. The founders that I run into who it's like, I won't tell you what our company name is until you sign an NDA. and I won't give you anything about it. You can't walk into our building until you've signed the NDA. You
You
can't
sign the NDA without thinking.
Yeah, all those types of things. And I feel like those companies tend to struggle the most from what I've seen. There's always exceptions, but I feel like if you can be open, people want to be open with you. They want to support you. I want to help people who are out trying to be collaborative and helpful in the community. And I think that's true of most people. So as a company, if you're closed off, you'll get people being closed off around you.
That's super interesting, Terry.
I think that's a great point. I guess this would be about BMO Harris. We're the 8th largest bank in North America. We've been one of the longest standing and oldest North American banks in China. We've got offices throughout the globe. If we're doing business together and or any of your other banks, but specific to us, and you're a company that's looking to start to do business overseas, back to the earlier question, come to me, how can I help? Put that kind of structure together for you to figure out the most optimal way. We're happy to connect you to the attorneys, but happy to also take that feedback in before you start spending money on some of those other service providers.
I got one last thing to add, I thought of. So, as a banker, one of the biggest pet peeves we have is when a business owner comes to us and says, well, I'm taking this to 10 banks, so give me your best rate. I will just say, good luck with 9, Yeah, it's not worth it. So if you're dealing with a good banker, like Ryan said, banking is kind of a commodity. What we have to offer is our knowledge, our skills, our tenacity, and willing to fight for you as a business owner and be your advocate and help you get what you need done. But we also want some sense of loyalty. It's a two-way street. And if we know that we have a captive audience and that we can do everything we can do to help you and that you're going to be loyal, that goes a long ways. So, if a business owner is working with us and we can't get anything we need on time and it's really, really, really difficult before we give you money, our first thought is, what's it going to be like after we give you money? So just be nice people that we work with because, we're humans. That's really what it comes down to.
I don't think you're a commodity. I think you guys add a lot of value, but let's get some questions out of the audience. Anyone want to ask this group? Burning question.
It's time for
Well,
drinks.
grab them in happy hour. Yes, and thank you so much for attending, and thank you to the panel. You guys are awesome.
Thanks.